Tim Quast, founder, CEO, Market Structure Edge. Tim, what's up?
Good Monday morning to you guys. I don't even know what an inside day is, Joel. You're going to have to explain that to me.
Well, it's
Dennis,
like during
nice
the
to see you
pandemic,
back.
you don't leave your house the whole day. It is called an
inside day.
It's an inside day.
That's an inside day.
You don't go anywhere. Hey, I went to downtown last week. I'm going again this week, so I'm breaking out. Inside day, easy. We'll teach everybody this. You trade within the previous day's range. You don't see the previous day's low, and you don't see the previous day's high. And what you like to see is a couple inside days. And then people are like, oh. And then once in theory, call an inside day, 2 inside days, you go with the momentum, right? To the upside. And then it gives you, and the other thing that's nice about those trades, if you do have those inside days and you follow the upward momentum, you don't have to wait forever in the day to find out you're wrong, right? Because if it breaks out of it and then comes back below it, you're like, we're still staying in this range. So is that a good explanation for you?
It is. But it reminds me of a Shakespeare line, which
too,
wouldn't it? Right? Yes.
Long to be or not to be? That is the question.
From the widely read Coriolanus, the last 2 tragedies that Shakespeare wrote, he said, a very little thief of occasion will rob one of a great deal of patience and maybe money. So you have to be very, very cautious about those thieves of occasion. Like, it's right there in front of you.
That's not what
I've left everybody speechless.
That's not what the footnote version said.
I was very poor in
books.
English class. The Shakespeare books we were supposed to read, a lot of times I didn't read them. I'll tell you right now.
Cliff notes.
Joel never read any of them either.
I also
so I had the great fortune to go to a tiny little rural school with about 100 people in it. And so if you were an overachiever, which of course I was, then you would then the superintendent would put together a Shakespeare class and teach you Shakespeare. So I learned Shakespeare when I was 18, and it was huge for me because none of it made any sense until I understood it. And
still doesn't make any sense to me.
It's like market structure, Dennis. None of it makes any sense until you understand it, until you get the building blocks.
All right, Tim, tell us what the market structure is saying right now, because now we've had 2 tough weeks in a row here, and people are starting to question their everything.
Well, I'll give you good news and bad news.
Great.
So the bad news is we are at the worst sentiment of 2021.
Oh.
Interestingly. So we have gone, which has never happened in the whole time that we have run this little algorithm that we call market structure sentiment, which has been for better than a dozen years. Have we gone a full year without dropping meaningfully below 4? It's a 10-point scale. So the market tends to spend its time between 4 and 6. Here, I'll show you. So we are at the worst reading of the past year. And so the bad news is it's bad. Bad news is that's no good. The good news is those always mark bottoms. It doesn't mean it happens immediately, but they are historically every single time that the market has dropped below 4, it has marked a bottom. If we back up, I'm just going to back this all the way back up 3 years. I'll zoom it in so you can see this. So here was the giant bottom of the pandemic correction. These are the all-time lows that we've ever recorded. And so the good news is that was a bottom. If you had the fortitude to recognize that it's not a little thief of occasion, but a real opportunity, you could, and I put money in there. I was a little bit early, but I did because of that. So if you looked at each of the times that the market has dropped below 4, it has marked a bottom. It has occasionally had a second bottom that follows it, and probably there's some technical explanation for that, Joel, that you would know better. But here's where we are right now. This is the worst reading all the way back to 2020. We had one of these in November of 2020. November 5th of 2020, we dropped all the way to 3.2. But notice what happened after that. The market was an absolute rocket sled. Now, I'm not saying it's going to be. I think we should talk about why tech is struggling, but we are nearer a bottom than a top. So the question is how long it takes to recover. One of the things that the data show is that it tends to take a couple, 3-4 weeks.
But Tim, we're looking at the S&P, and I mean, we're down 4% from the all-time highs. This is not even a significant sell-off. This is not even the biggest sell-off of the year, which somebody was just saying in the chat. We've been down as much as 5.2% this year. So really, the S&P,
exactly,
and the S&P is probably, you know, not even close to even a correction here yet. So
not even close.
So.
Right.
Is that where you're looking? Is like looking at that, you know, the S&P overall here, or do you get a completely different reading when you look at something like ARKK?
Yes, clearly you would. This is the composite data for the 500-ish stocks that make up the S&P 500. So we take the sentiment readings for all of them and create a rolling average, and that's what this line is. And then we compare it to SPY, just a proxy for the S&P 500.
Yep.
And so that's what we're looking at. And of course, that will smooth out the pockets like ARKK, which is heavily concentrated in tech. And tech has taken it on the nose. There's no question. Here's the interesting thing to me about tech. If you look at tech, let's go down here and look at the whole sector, because we can look at the whole sector the same way.
Sure.
And here it is, comprised currently of 445 components. The lead behavior is fast trading. That's Citadel, Virtu, Hudson River Trading, Two Sigma, Quant Lab, Infinium, GTS, on it goes. And notice this, that it's actually bottomed. The tech sector has actually bottomed very low, one of the lowest, perhaps lowest reading of the year. And look at the supply side. So short volume was very high. So everybody shorted tech as demand vanished and tech imploded. But now that's beginning to turn. Short volume is beginning to come down. Excess supply is starting to recede, and demand has bottomed. If those things reverse, tech is going to boom. I'm not saying that's going to happen. I can't tell you where the money will go. We can watch where it goes. That's the good news. Rather than trying to guess, we're just going to watch that. And you mentioned Procter & Gamble, Dennis. There's no question that when the market does things like this, it's going to move into low volatility stocks. Same thing we tell people. We highlighted HPQ. Hewlett Packard has been awesome. We've highlighted this.
Or not all-time highs, but 52-week highs. Yeah.
And it's a tech stock, but look at the divergence between demand and supply. When demand and supply diverge, I don't care what the market is doing, there is opportunity. And that happened there. If you look at Clorox, what did Clorox do? Well, it's not quite as good, but demand was very stable at 5. Supply is a little over trend, but tipping down. Here's where you really saw the value move. Right here at Thanksgiving. It was right around Thanksgiving when money said, okay, we want to be cautious because we don't know what's going to happen. And we looked at Apple. Apple was a hedge. We could see that in Apple. Procter & Gamble right here, Dennis, that you were talking about. So look at this. It's never not a 5. It's just a perfect 5. So if you're concerned about volatility, park your money in Procter & Gamble. It's the place to be. Supply is a little high, but it's crazy how well that works. It's a great lesson for traders. Traders, when the market turns volatile, put your money in the 5s. When the volatility diminishes, go back to growth. I'm with you, Dennis. I don't think that this marks a sudden shift to value. We in the data can find no evidence except a little bit on Friday of any kind of selling by big money. It's been all fast trading. There was a little reactionary active stop loss selling on Friday. It's the first that we've seen. Now, if that compounds, then we'll have more trouble. But there has been no passive selling to speak of. And it tends to be that passive money returns in new months, it doesn't sell in new months.
We've got the tale of two markets here. And, and obviously, like I've talked about my long-term portfolio, which is value-oriented. I've always kind of been a value guy since I got my butt kicked back after 2000. I kind of learned the hard way is that I never buy a stock with a PE over 30. It's just not in my long-term account. And, I'm looking at my value-driven portfolio, and it's sitting up near all-time highs. And and there's a lot of other people are probably value investors saying, you could probably look at Berkshire Hathaway, Berk.B, and say, wow, it's a little bit off the highs, but he's nowhere saying, whoa, where there's carnage in the streets everywhere. He's like, what carnage? There's a lot of portfolios that are doing very, very well still. And then you've got these growth-oriented portfolios. It's a completely different animal that they've been imploding for the last month to the tune of 30%. So does this trade just reverse itself again? That's what I want to get to the question. Do we eventually just go back to the trade that has been working for the last decade in the high growth names? Because the high growth names are all on sale.
They sure are. So my answer to that, and it's not a strategy answer, it is a purely common sense answer, that if roughly, I'm going to say roughly 50% of market cap, if you look at tech, communication services, consumer discretionary, there is tech in all of that. That if you look at tech in the market, it is almost 50% of market cap. So unless we're going to see passive strategies dissolve, then the answer is yes, we're going to go back to it. I mean, I think at some point, our very profligate use of currency is going to catch up to us, and our market will become the Japanese market, incapable of rising. But I don't think we're anywhere near that. So absent that, and absent a sudden destruction of passive strategies, which I don't see, and I don't think it's going to happen so long as we have Reg MS, then yes, we're going to see a reversion to growth merely because that's where the money is.
Tim, could you go back to that first chart that you had showing the S&P composite versus the SPY? Could you go back to that?
You bet.
Because I was looking at the top for the composite stocks versus the SPY, all right? I mean, this is much different here. You had everything on sale. Could you say the only reason that it's holding up here is because of 5 or 6 stocks? And if we lose leadership in those stocks, you could easily get something like this or like this. I mean, because this is like you look at it here, and it was probably a much better representation of the entire market. Here, you're looking at this thing coming down from, the indicator coming down, but I mean, is it like I said, is it just those 5, 6 stocks that are almost 25% of the index holding us up?
Could be, right. It's one or the other. Is it that the market is down the amount that it is, and sentiment has declined to the degree that it has because there has been trouble in big tech? It might be that instead, in which case most of the market is fine. Now, clearly the small caps have suffered, but remember, they're only 5, 6, 7% of the market at all. Mm-hmm. It's such a small part of the market that you can't look at the Russell 2000 and draw any form of broad conclusion. The S&P 500 is a very nice representation at 85% of market cap and a good blend to me. So I don't know. I think maybe the answer is let's go look at the FANGs, because there's the bulk of market cap. What are the FANGs telling us is going on? Well, you could see the FANGs absolutely collapsed. So this collapse in demand, and once again, it's the same behavior, fast trading. I have 11 stocks in here, just things that I put in this portfolio. But look at the supply side too. The supply side was very high back here, and now it's come way down. If we look at the components here, does this explain to us what is going on? Well, I think in large part it does, because roughly half this group is below 5. So Netflix, Shopify, I put Shopify in there, Facebook, both Goog stocks, Amazon, all below 5. AMD, Microsoft at 5. We don't have anybody doing really well. All of these trends are either bottomed or down. But if they're bottomed, I mean, look at this. If we have a surge back into tech, Netflix is going to scream. because look at the demand and supply. The supply side has collapsed. The demand side has too. If this moves, so is Netflix. If Shopify, does I look at this and say, wow, Shopify could go up $300-400 if there's a change in demand. AMD, I think AMD is a fabulous. Look at that. I mean, demand has come down to 5 and supply has absolutely collapsed. I look at those and say, if there's any form of institutional money coming back into tech this week, those stocks are going to move and we're going to be off to the races into Christmas. I'm not saying that's going to happen. I'm saying there is the possibility of that.
All right, Tim Quast is the founder of Market Structure Edge, joins us every Monday from Market Structure Mondays. Learn more from the link in the description and chat. Tim, a pleasure as always. Have a good one.
Have a good week, guys. Good to see you.